Hi, welcome back to our channel. If you're new here, hi, I'm Antonia. I'm a licensed accountant and business owner. I own Abacus Jack with my business partner Andy. And our mission is to help small business owners get more financially confident by explaining things properly and working with you throughout the year so you can make better decisions with more recent data. Today, we're going to cover a common topic. When you have a limited company and you're a director and you transfer some money out of your bank account, then what does that mean and what do you do with it? What is the best way to pay yourself as a director? So firstly, Andy, as we go into this topic, it can be a little bit tricky with how you do it and there's multiple ways of doing it. So firstly, could you maybe explain one way of doing it that's quite common for people?
Definitely, yeah. Probably one of the easiest ways to pay yourself as a director, and perhaps what you're used to if you've come from employment, is a salary. So as a director, you can be an employee of your limited company, and that means you can take a salary. Now, a salary is a really good, structured, simple way of taking money out of the business. So you pay yourself, presumably on like a monthly basis, you pay yourself a salary, and how does that work? Well, first point to make here is that salary is an expense to the company, just like other expenses like software or legal fees or equipment. So salary is an expense, and that means that the business, your limited company, saves corporation tax on that expense. So that's a really good thing. So in other words, the more you pay yourself, the higher the expense, the lower the tax bill for your limited company.
How do you set yourself up as an employee in a company?
Well, that's a good question. So the company would need to apply to HMRC to have a PAYE scheme, pay as you earn scheme. In other words, set up as an employer. And as the director, you may well be the first employee to go onto that scheme. And as you grow and you bring people in, obviously you might have more employees. So you have to do that. It's an online process, or your accountant can do it for you. And HMRC will typically send you the reference numbers that you need as an employer and set you up as an employer. So the way salary works is that you decide the amount you're going to pay yourself. And this is really important because, yes, on one hand, it is an expense to the business, but obviously the more you pay yourself, the more tax burden you have personally. And if you've come from employment in the past, you'll be well used to how that works. You get your pay slip, it shows the amount you've paid gross, sort of the full cost of the salary, and it shows the deductions in terms of tax and national insurance. No different if you're paying yourself as a director through a salary. You will be taxed personally and you will pay national insurance. The level of salary depends, or determines rather, what amounts or what percentages are applied. There's a sweet spot that many directors look at, and that's to take a salary of £12,500 a year, 12,570 to be exact. And why is that important, or why is that relevant? Well, that is the same level as the UK personal allowance. So everybody in the UK can earn £12,500 a year free of income tax. So that is a real sweet spot. It means if you set your salary at that level, then you will pay no income tax. You might pay some national insurance. That's probably a separate conversation because there's various intricacies about when national insurance kicks in, but you won't pay income tax. But yet the business still saves that £12,500 as a business expense, so it saves the corporation tax. It's a really good point to start. But what I would say is to be efficient in terms of how you pay yourself, we need to look at the overall picture, because £12,500 a year won't be enough for many people. And you've got your bills, you've got to live, you've got things to pay for. So we need to look more in depth at how the best structure is to pay yourself as a director. It might be to take a higher salary, and yes, there'll be some tax implications on you personally, but remember the business is saving tax. So again, it's a balance. But we also need to look around things like dividends. So how do dividends work?
That's an interesting question, yeah. And I think when we talk about this with clients, we're trying to get that balance, like you've mentioned. And a good starting place that we start with clients is asking them how much do they need per month? So, what are we trying to reach in terms of a salary? Because small business owners sometimes don't have enough money to pay themselves market rates. But what we're trying to achieve is a good balance for the business owner that they're getting paid enough that they can meet their monthly obligations. So, a dividend is something that comes out of a company's profit. So if a company has a profit and loss for the period, they have an operating profit, which is your sales minus your expenses, then they're left with a profit. That then suffers corporation tax, and after that you have something called a distributable profit, and that's where the dividends can come from. So as a director, you could say we expect to make £3,000 a month profit after tax, and that means that we could mix that with a salary to achieve maybe a £2,500 net amount into a bank account for a business owner. When you have a dividend, that is literally transferred out of the bank account to the director with another payment from the bank account as a salary, and then that reaches an overall amount for the month. What you then need to do with a dividend is you're going to suffer self-assessment tax on the dividend, and it's not a deductible expense like the salary is. So you don't save any tax for the company by taking a dividend. You're literally just taking what it's earned and giving it back to yourself. So when you get that into your bank account and you're taking it from the bank of the company into the bank of the director, that becomes taxable. You've received the benefit of that money, so the government wants their share of it, and that's taxed through self-assessment. Depending on the level of dividends that you take against your salary, so everything gets looped together into the same tax calculation for the tax year, depends if you'll end up being a basic rate or a higher rate or an additional rate taxpayer. And because of that, you'll get different rates like an income tax for the dividends, which are slightly lower than what you would pay on income tax. But because you've already paid corporation tax on the money that you're taking as a dividend, it's not as cheap as you might think. You do get a £500 dividend allowance, which is tax-free per year, and this is less than what you would get on a salary, which is your £12,500 tax-free personal allowance. Now, this is why you want to achieve a balance as well, because if you took all of your income as a dividend, then you wouldn't use your personal allowance because the dividends are not income. So you have to be careful with that as well. Once you've reached a point with the business that you've got enough that you can take home, and you can review that, every 6 to 12 months and make sure that as the business performs, you're getting rewarded as well. You might also want to think about taking benefits out of the business as well for the value that you're putting into that role. So is there anything else, Andy, in terms of once we've got our pay sorted, we're getting paid enough at the end of the month, is there any other benefits that we can get that works well for the company?
There is one third element to a director's sort of overall remuneration, and I think it's perhaps one that gets overlooked sometimes, and that's pension contributions. So not everybody necessarily needs to take out a certain amount of money each month. If you're in a position where you've set up a level of salary and perhaps you've even set up a level of dividends and you're comfortable with that, there may be some additional profit there that we can use in a really tax efficient manner, and that's where the pension contributions come in. So as a director of a limited company, your company is able to make pension contributions on your behalf. In other words, the company pays your pension. The money isn't coming from you personally, and it's not being taken out of your salary like it would be for your employees. It's quite simply a payment from the business to the pension provider. It's also 100% allowable expense, tax deductible expense for the business.
That's good.
It's a real no-brainer. There is one bit that's really important to emphasise with pensions though. In order for the company to pay the pension, obviously the company's got to have the money. So yes, it is a tax deductible expense, but it is going to impact your cash flow. So you have to think about whether or not the company can afford to make the pension contribution, and whether or not that'll impact other expenses that the company's got to obviously honour and afford.
Yeah, like your take-home pay as well, because if you increase that pension too much, you increase your expense. That means you reduce your profit. Your dividends come from profits, so then you haven't got enough dividends to pay yourself this month, and that becomes an issue.
Absolutely. It's about working out a balance that works for you, and that balance is going to consist of all the elements we've talked about. So salary, dividend, if there's profit, and pension contribution if that's something that you're looking to do. But yeah, the pensions is a really tax efficient way of reducing your profits and therefore reducing your corporation tax. Yet there's obviously a long-term benefit there in the sense that you're building up a pension pot for future years that the company has contributed to.
Yeah, I really like that idea because investing in your pension earlier in your career gives you the opportunity for when you invest that money now for the interest to compound throughout the life cycle of the pension. So then when you reach 55 and you can withdraw a lump sum tax-free, then it's going to put you in a really strong position for your retirement. Cool. So I hope that helped everybody. I think we've been through a few options there. And like we say, it's all about coming to a balance. And that depends on how the business is performing and tracking all your figures throughout the year. If you have any questions about calculating your take-home pay or how you should mix it up, then drop us a comment or get in touch with us and we'll be happy to help you. Remember to like the channel and subscribe for future videos around topics like this where we try and help you a bit more. And if you have any questions, you know where to find us. Thanks and see you next time.